You bought silver, thinking it was gold's little brother, a safe haven. Then one Friday in late January 2026, silver falls more than 20% in a violent intraday crash after margin hikes and forced liquidations. Your safety asset just behaved like a leveraged tech stock. Meanwhile, gold dipped, but held up far better. That day didn't just hurt people's portfolios. It exposed a dangerous myth. Silver is not the same kind of safety as gold, and confusing the two can cost you years of savings. In this episode, I want to show you why I call this villain asset confusion, and why getting this wrong can wreck your retirement plan. We'll do it through the story of one person who might look a lot like you. Meet Bob. Bob's not a trader. He's a normal guy in his 40s with a job, a family, and a simple goal. I just don't want to be poor when I'm old. He scrolls through his phone and sees what you see. Inflation, recession fears, currency drama, political risk. So he decides, I need a safe haven. I need gold. And hey, silver is cheaper, so I'll buy that too. Bob, gold and silver are basically twins. Two shiny metals, both precious, both promoted as protection. Same team, right? Wrong. That's asset confusion in action. Asset confusion is when you buy an investment for the wrong reason at the wrong time, because you don't understand what job that asset actually does, and silver is the perfect trap for this. In the old days, silver and gold were both money. But in today's economy, silver has a split personality. About half of its demand is from investors and jewelry, and around half, even more in recent years, is from industry, solar panels, electronics, EVs, AI data centers, medical devices. Recent data shows roughly 55 to 60% of global silver demand now comes from industrial use. Only the remaining 40% is classic, monetary, or jewelry demand. And here's the key. When silver is used in these technologies, it usually isn't recycled the way gold is. It's spread in tiny amounts across millions of devices and panels. We mine it, we use it, and then a lot of it ends up buried in landfills or locked inside. Tech that nobody ever recovers. Gold, by contrast, tends to sit in vaults, jewelry boxes, and central bank reserves. It accumulates. Silver gets used up. It's the metal of technology and growth, not the pure metal of money. Now here's the uncomfortable part. What happens in a recession? Factories slow down. Construction delays. Car sales drop. Solar projects get postponed. And that huge industrial demand for silver, it shrinks right when investors are desperate for safety. That's why, historically, when the economy slams on the brakes, silver can crash before it recovers. It behaves like a hybrid between a precious metal and a cyclical tech stock. Gold, on the other hand, often gains when fear rises because it's held as long-term monetary insurance. Take late January 2026. After a crazy bull run in 2025, where silver outperformed almost everything. Margin requirements were hiked, and speculative positions were forced to liquidate. Silver futures plunged in a single session, double-digit losses, while gold only saw a sharp but far smaller decline. Bob, who thought silver was his safe haven, suddenly sees his insurance down 20 or 25% in a day. That is not what you want your retirement protection to look like. First, counterintuitive fact. The AI and solar boom is devouring silver. Each solar panel uses silver. Every EV, every smartphone, every AI server stack needs it. That's why industrial demand has climbed above half of total silver usage worldwide. Over the last decade, industrial silver demand has steadily climbed. Silver is no longer just coins and cutlery. It's literally wired into the green and digital transition. But unlike gold, a big chunk of that silver is consumed in a way that's uneconomical to recover. It's like pouring your metal into concrete. Over time, the above-ground readily available supply gets tighter, even as we mine more. Second fact. Central banks love gold. They barely touch silver. In 2024 and 2025, central banks bought record amounts of gold, over 1,000 tons in a single year, as they slowly diversify away from the US dollar and look for neutral sovereign stores of value. Central banks don't do that with silver. They don't hoard silver in their reserves. This tells you something important. In the eyes of governments and institutions, gold is sovereign money. Silver is primarily a commodity. So when Bob thinks, gold, silver, same thing, he's ignoring the behavior of the largest, most informed players on Earth. Third fact, silver is usually 2 to 3 times more volatile than gold. When gold moves 1%, silver often moves 2 to 3%. That's great if you're speculating. It's terrible if you're a 60-year-old trying to protect your savings. Think of gold as the heavyweight, who moves slowly but steadily. Silver is the hyper-teenager bouncing off the walls. Same family of metals, completely different behavior in practice. Let's go back to 2008. Before the great financial crisis fully hit, silver was around $21 an ounce. When the panic struck and industrial demand suddenly evaporated, silver didn't act like a safe haven. It crashed, falling by more than half, from roughly $21 to around $9. Only later, when central banks started aggressive money printing, did silver stage a massive comeback. In other words, silver got punished in the crash, then rewarded in the money printing phase. Gold, by contrast, held up far better during the panic. Now go further back, to 1980. Silver hit about $50 as the Hunt brothers tried to corner the market. What happened next? The bubble burst. Silver collapsed from $50 down near $10 over time, an 80% drawdown. Investors who confused speculation with safety paid a brutal price. The pattern repeats. When silver is treated like a get-rich-quick ticket rather than a volatile tech-linked metal, people buy at euphoria peaks and sell at despair lows. So let's simplify everything into one sentence, the golden thread of this whole story. Gold is insurance wealth preservation, for when the economy dies. Silver is a technology bet. Wealth expansion, for when the economy grows. Do not confuse the two. Back to Bob. After watching his safe haven silver crash in early 2026, he finally asks the right question. What job do I actually need each asset to do for me? Every asset in your portfolio should have a clear job description. Gold's job is not to make you rich fast. It's to not die when the system shakes. Silver's job is to potentially grow your wealth faster when the system is functioning and technology is booming. But it can hurt you more on the downside. Bob realizes he doesn't have a plan. He has a collection of things he bought because they were shiny, cheap, or trending. That is not a strategy. That's a garage sale. So I sit Bob down and say, let's fix this. First, we separate your portfolio into 2 buckets, preservation and expansion. In the preservation bucket, Bob holds things designed to survive stormy weather. Gold lives here. It's not there to impress you. It's there so that if your local currency stumbles or inflation spikes, a portion of your wealth is anchored in something that doesn't rely on anyone's promise. Silver, if Bob still wants it, goes into the expansion bucket, with stocks, business interests, and other growth assets. He treats it as a leveraged play on industrial and technological demand, not as the core of his emergency plan. Just as an educational example, not personal advice, Bob might keep the bulk of his portfolio in diversified assets, put a meaningful but sensible slice into gold as insurance, and then reserve a small, clearly defined portion for silver and other higher volatility plays. The key is that silver is sized so that a 30 to 40% drop hurts his ego, not his ability to retire. Gold, on the other hand, is sized so that if everything else goes sideways, he still has a core of purchasing power intact. Now, when silver crashes on a crazy news day, Bob doesn't panic. He knew it was a speculative, growth-linked asset, and if gold holds its ground, or even rises, he understands why. The roles are clear. Now it's your turn. Before you buy another ounce of anything, ask yourself, 1. Am I buying gold as long-term monetary insurance, or am I secretly expecting a get-rich-quick trade? 2. Am I buying silver because I understand it's a volatile tied to growth, or because I've confused it with gold? 3. If silver dropped 30 to 40% in a month, which it absolutely can, would that ruin my plan, or is it a risk I've already sized for? Gold as your foundation, silver as a carefully sized booster. That's how you give each metal a clear job. Remember, gold is insurance for when the economy dies. Silver is a technology bet for when the economy grows. Don't confuse the two, and you'll already be ahead of most investors in the next crisis. Educate yourself, allocate with intention, and then, for the love of your future self, sleep well.